afternoon. Today we will be talking about call writing. My name is Charlie Quigley.
I'm Steve Halbig.
My name is Soy Mingyun.
And my name is Jake Inaminato.
Before we dive into our presentation, I first want to go over our agenda. To begin, we will go over synthetic puts, synthetic straddles, and authoring the ratio of long calls to short stock. Next, we will dive into naked call options, risk and reward, and written ratio calls. Lastly, we will be describing adjusting with the delta and stop orders. To begin, I will start off discussing the topic of synthetic puts. A synthetic put is when one purchases a call while selling a short of the underlying stock. Theoretically, risk is unlimited in a short sale, so by owning a call, a person limits their risk to a fixed, generally small amount. Additionally, it is best to buy a call that is slightly in the money or slightly out of the money as a protection for the short sale. To calculate one's maximum amount of risk when dealing with synthetic puts, you would take the striking price of the purchase call plus the call price minus the stock price. To illustrate, let's look at an example where an investor sells Apple stock short at 40 and simultaneously purchases an Apple July 40 call option for 3 points. Given this example, a variety of outcomes can occur. If Apple falls in price, the short seller will make his profit on the short sale minus 3 points paid for the call. On the other hand, if Apple rises in price, the short seller can cover his short by exercising the call and buying stock at 40. Also, it is important to note that the break-even value in this scenario is 37 and not 40 because of the call option purchased for 3 points. To follow up on a synthetic put, in normal conditions, the protected short seller only needs to close out his or her position for this strategy. If the underlying drops, the short sale can be covered by selling the long call. There is potential profit on the call side as well if the stock comes back above the striking price. If the underlying rises, the holder should not sell his long call because he or she will lose the protection. Moving forward, the new margin rule allows to receive favorable margin treatment when a short sale of stock is protected by a long call option. Generally, the new margin rule is the lower of 10% of the call striking price plus any out-of-the-money amount, or 30% of the current short stock's market value. For the following example, assume someone is considering a short sale of 100 shares of Apple at 47 and wants to purchase one of the options, either October 40, October 50, or October 60, as protection. In calculating the margin requirements, we can see the October 40 has the lowest margin, while the October 60 has the largest margin requirement, 30% of the stock's price. Next, a portfolio margin is a certain way option trading accounts can increase their leverage beyond federal regulation margin requirement, only with brokerage firms' approval. In addition, these portfolios only apply to options, not futures. In general, brokerage firms have requirements for qualifying for a portfolio margin treatment, such as an account size of 100,000, answering an option questionnaire, or taking a brief option test. These requirements are risk-based and can be hard to measure. To ensure accurate calculation, many brokerage firms use a calculator provided by the OCC. The next topic I will be introducing is synthetic straddles. A synthetic straddle occurs when one purchases a call on more shares than he or she has sold short. When dealing with a synthetic straddle, one can profit if the underlying stock rises far enough or falls far enough during the life of the option. All other things equal, synthetic straddles have a limited loss potential, usually amounting to a moderate percentage of the initial investment, and theoretically have unlimited profit potential. To determine one's maximum risk, you would take the striking price plus the product of 2 times the call price minus the stock price. Once you have calculated the maximum risk, both the upside break-even and downside break-even values can be computed. For the upside, take the striking price and add the maximum risk. For the downside, take the striking price and minus the maximum risk. Using these formulas, we will go over an example of synthetic straddle in the next slide. For this example, imagine Apple is currently selling at $40 and the investor shorts Apple at 40 and purchases 2 Apple July 40 calls. As we can see, profits occur when the stock drops below 34 or rises above 46. Furthermore, utilizing the formula in the last slide, we can calculate the maximum risk as 6, where 40, the striking price, is added to the product of 2 times the call price, 3. Next, the sum of the previous 2 is subtracted by the stock price, 40, to reach the maximum risk of 6. Using this, the upside and downside break-even can be easily calculated as 46 and 34, respectively. Given the example, it is clear that synthetic straddles profits occur when the underlying stock moves in either direction greatly. Furthermore, one would only incur a loss if the underlying stock does not move at all. Moving forward, Steve will describe the follow-up actions of a synthetic straddle.
Because synthetic straddles have a limited loss feature built into them, no follow-up actions are required for preventing losses. This feature is appealing to many investors. The alternative to taking no action is trading against the straddle. This is done when the stock has moved far enough in either direction to generate a profit. The disadvantage of doing so is that you cut off profits at a small, limited amount, thus losing out the opportunity for a larger profit. As we can see on the graph, this is betting on the volatility of a stock in a given period of time. The greater the stock moves, the greater your profits. An investor may alter their ratio from 2 to 1 in order to make their position more bullish or bearish. The different ratios in an investor's portfolio give us insight to their strategy and feelings about the market conditions. By altering this ratio, the trader can change his position. For example, if Apple is trading at 40 at expiration, the downside break-even price would be 31, which would result in a 9-point profit on the short sale, which would also be offset by the 9-point loss on the calls. The upside break-even point when doing this stock would be at 44.5. 450 would be lost on the short sale, but 150 would be made on each call, totaling a profit of 450. By doing this, you diversify your position in a neutral way with the ability to shift into a more bearish or bullish stance if desired. Those can have more than one strike price. In this example, the trader shorts 100 Apple shares at $37.50 and buys one Apple July 40 call for $2 and one July 35 call for $4. When he shorts 100 Apple shares at $37.50 and buys the calls, he would have a position similar to a synthetic straddle, except the maximum risk would be between 35 and 40 at expiration. This is illustrated by the graph. As you can see, unlike the earlier example, this graph has a long flat bottom as compared to the pointed bottom of a normal straddle. By implementing multiple strike prices, the risk is over a wider range. The upside is that there is large potential profits if the stock can swing far enough in either direction. The strategy is typically used when the stock is centered between 2 strike prices and the investor wants to maintain a neutral positioning between these points. To summarize, synthetic straddles are used when the underlying does not have puts listed or the puts are illiquid and the investor believes the volatility is high. Because the strategy used options, it has an advantage of defined risk. Most of the time, losses are only 20 to 30% of the initial investment. Because of how it works, the best follow-up action to the strategy is to let the position stay open. Unlike other positions, it is not good for locking in small profits along the way.
I'll be talking about the naked call option. A naked call is an option strategy which an investor writes or sells a call option on the open market without owning the underlying security. A naked call option strategy has limited profit potential and theoretically has unlimited loss. Because of this structure, it's the least likely chosen method used for some investor. In more definitional terms, using this example where Apple is selling at 50 and June is at 50 call and it's at selling at 5, if we was to sell on July 50 call naked without owning any Apple stock, we will make a profit of 5 points. The profit will only be accrued if it's below 50 at Microsoft expiration at any lower prices. If the Apple's call was to rise, it would be a huge loss of money. Naked call writing is not the same as short sale of underlying stock. When comparing both strategies, it's very similar. Both have large potential risks, but in the short run, underlying stocks has higher reward potential. But in a naked call write, it will do better if the underlying stock remains the same. An example would be if July was at 50 call naked for 5 points, while another investor sold the stock short at 50, If Apple was at 52 when expired, the naked call writer would make a 2-point profit, whereas the short sale has a 2-point loss. But some of the benefits of a naked call option is even if the stock moves up, it won't necessarily lose money. It will only lose money if the stock advances more than the premium. So following the next slide, if we take a look at figure 5.1 where the dashed line is a short sale of Apple at 50, when we compare it with the naked write of July at 50 call, if we was to take a closer look at these two strategies from short sales and naked write, they will both be equal at 845. Anything above 45, the naked write does better. It has larger profit and smaller losses. But anything below 45, short sale does better. And the farther the stock falls, the better the short sales are in comparison. I'll be talking about investment required. So we have to look at this margin requirement formula for a naked call option, which is 20% of the stock plus the call premium minus or less by the amount which the stock is below the strike price. However, you must have a minimum of 10% of the stock price required for each call, even if the computation is smaller. The option collateral requirement is usually computed on a daily basis, similar to a short sale stock, but a naked call does not need cash to be invested if one has a good amount of collateral alone to protect them. Going back to the previous slide, which I talked about investment required, I ended off talking about collateral. To go more in details about collateral requirement, let's take a look at table 5.2. There's 4 different examples of the initial margin requirement of 20% collateral, which is the minimum exchange requirement. It may vary somewhat among the different brokerage house, but getting to the question, if Apple July 50 was to be sold at 7 points, the $700 call premium could be used for the $1,800 margin requirement, which would reduce the amount to $1,100 as long as the investor puts up a collateral of that amount. The fun fact of it is that since naked call is such a high risk strategy, at some brokerage firms require customers to show your trading experience and your financial statements of your trade before approving your call. Risk and reward. There's 2 different naked calls. One is in the money and one is out of the money call. Out of the money call offers a high probability of achieving a small profit. In the money call has the most profit potential but has the most largest risk. One example of out of the money naked call would be if Apple was selling at 40 and July's at 50's call option is selling for H. The call could be sold naked. The probability that Apple could rise to 50 by expiration is small, especially if there's not a huge amount of time left. But even if the stock rises 25% or 10 points to 50, it will expire regardless and will be worthless. So in this scenario, the naked writer has a good chance of realizing a $50 profit, which is small. Another example of in the money call would be if Apple was selling at 60 and at July it's selling at 50's call option, which is selling for 10.5. If Apple was to rise, the naked writer would lose money because it's at a 0.50 time value of premium in the call. But if Apple was to fall, the writer will make a point for point basis until the stock falls much closer to 50. For example, if Apple was to fall from 60 to 55, the call price would fall about 5 points, making the decline in the stock deep in the money. The writer can provide benefits nearly equal to those of the short seller. Moving along, I'll be talking about the follow-up action. Naked call writing has a huge risk. One must monitor the position consistently. The simplest way to limit the losses is to have some sort of stop in mind for the price. I will be talking about the formula, which is the annualized current return. In this formula, it will be call price divided by the margin requirement times the time remaining to calculate the amount of earning to see if the write is worth setting up. So I'll be talking about a quick example, which let's just say Apple was at 45. A trader writes July's 50 call option, which is naked. They're selling it for $1. The break-even point on this write is 51 at expiration. The trader might wait until it rises to 51 to reap the benefit before he stops himself out of the call. But there is another opportunity. It can rise above 51, but if the probability is too low, the call should be covered and a new position should be established elsewhere. Rolling for credits, a strategy that should be avoided, but it appeals to a certain set of option traders. Usually this strategy applies to at the money call, where they follow up on a previous naked call, right, where the stock has risen to strike price. So one is short at the money call. Usually we would have to wait towards the stock reach the next strike price. In this situation, it would cover the short call. We can write more call for the next strike within the same month. One would do this repetitively until the stock is pulled back or worthless to the profit from the initial credit. Previous slide, I talked about rolling for credit, about the definitional term. If we was to take a look at table 5.3, this explains the definitional term. This shows how a trader would effectively execute this strategy and make profit towards the end when the call expires. Rolling for credits, the only downside to the strategy is that over time we have to increase in collateral requirement. As you can tell from our table 5.4, we first start off with initial 5,000 collateral required, then it increased to 9,600 collateral required, and then it increased to $21,000 collateral required. This shows that even if we make a small profit in the long run, it takes a large amount of collateral amount of money to make sure that we execute this strategy correctly.
Alright, so now we're going to talk about ratio call writing. Ratio call writing is a combination of covered call writing and naked call writing. It is the strategy in which one owns a certain number of shares of the underlying stock and sells calls against more shares than he or she owns. This results in a ratio of calls written to stock owned. The most common ratio is 2 to 1, where one owns 100 shares of the underlying stock and sells 2 calls. The resulting position has both downside risk, like a covered write, and unlimited upside risk, similar to a naked write. This provides much larger profits than either covered writing or naked writing if the underlying security remains relatively unchanged. There's a two-sided risk, which is a quality absent from either covered call or naked call writing. The investor also tends to be neutral, meaning they write calls with striking prices close to the current stock price. Now we're going to go over an example of a ratio write. A buys 100 shares of XYZ at 49 and is selling 2 XYZ October 50 calls at 6 points each. If XYZ declines below 50, the calls expire worthless, and the writer would make 12 points. Thus, even if XYZ drops 12 points to a price of 37, the ratio writer will break even, as the loss would be offset by the gain on the calls. The max profit occurs at the striking price of the written calls. If XYZ was 50 at expiration, the calls would expire worthless. The writer would make 12 points and 1 point profit on the stock for a total gain of 13 points. If XYZ rose above 50, the profit will decrease and eventually become a loss. Now suppose XYZ is 63 at expiration. The calls would be valued at 13 points each, 7 point loss on, which would result in a 7 point loss on each, 14 point gain on the stock, and the overall break even is at 63. To continue this example, let's take a look at the profit and loss chart at October expiration. The left side shows the price of XYZ at expiration. As the price reaches the strike price, the profit is at its max. When the price deviates either upward or downward, the profit decreases and eventually becomes a loss. Now I'm going to talk about the investment required in a ratio write. The ratio writer has a combination of covered writes and naked writes. The requirements are the sum of requirements for both naked and covered writes. This normally is done in a margin account, but you could keep the stock in a cash account. There may be minimum equity requirements and maintenance requirements also, and this is because naked writes are involved. These vary from one brokerage firm to another, and it is best for the ratio writer to check with his broker before he writes the call. To illustrate the investment required, let's go over an example. An investor buys 100 Amazon at 49 at 50% margin and sells 2 Amazon October 50 calls at 6 points each. The 70% of stock cost is made up of the 50% of the stock price used in covered call writing and the 20% of the stock price used in the naked writing portion. The money paid for the call premium on the naked portion would be $600, and the premiums received on the covered writing would be $1,200. This results in a total requirement of $2,730 plus commissions. Next, we're going to talk about selection criteria. To decide whether a ratio is a desirable position, the writer must determine the break-even points of the position. Once the break-even points are known, the writer must decide if the position has a wide enough profit range to allow for defensive action, if necessary. Here are some useful formulas to help decide if the ratio right is a desirable position. The points of maximum profit are used in other formulas. The points of maximum profit could be found by using the strike price minus the stock price plus 2 times the call price. The downside break-even point equals the strike price minus the points of maximum profit, or the stock price minus 2 times the call price. The upside break-even point is the strike price plus the points of maximum profit. To illustrate these formulas, let's go over an example. A writer is buying 100 Amazon at 49 and selling 2 October 50 calls at 6 points each. To find the point of maximum profit, you take the strike price, which is 50, and subtract it by the stock price, which is 49, plus 2 times the call price, which is 6, giving you a total of 13. This number is then used in the next two formulas. The downside break-even point is found by using the strike price, 50, subtracted by the point of maximum profit, 13, for a price of 37. The upside break-even point is achieved by using the strike price, 50, plus the points of maximum profit, 13, equaling 63. The profit range is wide enough to allow for defensive action if necessary. In theory, one would want the profit range to be wide in relation to the volatility of the underlying stocks. Volatile stocks are the best candidates for ratio writing, as the premiums will more easily satisfy these conditions. Now we're going to talk about the variable ratio right, or the synthetic short triangle. In ratio writing, one generally likes to establish the position when the stock is trading relatively close to the striking price. The synthetic short triangle is useful when the stock is nearly exactly between two striking prices and neither in the money or out of the money call offers a neutral profit range. If one still wants to be in a 2-to-1 ratio of calls written to stock owned, they must write 1 in the money call and 1 out of the money call against each 100 shares of common. This is also known as a variable ratio right, or a trapezoidal hedge. Now we're going to look at some formulas to illustrate this position. The point of maximum profit equals the total option premiums plus the lower striking price minus the stock price. The downside break-even point equals the lower strike price minus the points of maximum profit. The upside break-even point equals the higher strike price plus the points of maximum profit. To further illustrate a synthetic short strangle position, let's go over an example. You're given the following prices: Apple Common 65, Apple October 60 call 8, and Apple October 70 call 3. Table 6.5 depicts the results from this synthetic short strangle position. In the table, it is assumed that the option is bought back at a parity to close the position, but if the stock were called right away, the results would be the same. As the price deviates to the lower or higher end, you'll notice that there's a loss of $900. To achieve maximum profit, the price needs to be close to the strike price and would result in a profit of $600. There are 3 approaches to follow-up action in ratio writing. The first is to roll the written calls up if the stock rises too far, or to roll down the stock if the stock drops too far. The second is to use the delta of written calls, and the third is to utilize stops on the underlying stock to alter the ratio of the position as the stock moves either up or down. I'll address each of these approaches in following slides. In addition to these types of defensive follow-up action, the investor must also have a plan in mind for taking profits as the written calls approach expiration. First defensive action we're going to talk about is rolling up or down. A rolling action is defined as the currently written calls are bought back and calls at different striking price are written. The ratio writer can use rolling actions to his advantage to readjust the position if the underlying stocks moves to the edge of the profit ranges. Investors would normally want to roll exactly at the striking price. Having to take rolling defensive action immediately after the position is established is the most detrimental case. To combat dramatic moves, writers must alter the ratio of their right. To illustrate the rolling up or down defensive action, let's go over an example. A ratio writer bought 100 Amazon at 49 and sold 2 October 50 calls at 6 points each. Subsequently, the stock drops in price and the following prices exist. Amazon at 40, Amazon October 50 calls at 1, and Amazon October 40 calls at 4. To roll down on the October 40 calls, you would buy back 2 of the October 50s, and in doing so, the writer would reestablish a somewhat neutral position. The profit on the buyback of the October 50 calls would be 5 points each, and the writer would realize a 10-point gain on the 2 calls. The resulting position would be long 100 Amazon at 39 and short 2 Amazon October 40 calls at 4. The profit range would be 31 to 49, and the new neutral position would be 40. The investor is now in a position to make profits if XYZ remains near this level, or take further defensive action if the stock has a dramatic change in price. The next defensive action we're going to talk about is adjusting with the delta. The delta of written calls can be used to determine the correct ratio to be used in the ratio adjusting defensive strategy. The basic idea is to use the call's delta to remain as neutral as possible at all times. The number of calls to sell equals the round lots held long divided by the delta of call to be sold. When establishing a new position, one must first decide how many shares of the underlying stock he could buy before utilizing the formula. The number of round lots to buy equals the current delta times the number of short calls minus the round lots being held long to buy. If a negative number results, stock should be sold, not bought. An equivalent stock position, or ESP, equals the option quantity times the delta times the shares per option. This is the most general approach, and it could be applied to any strategy. The final defensive action we're going to talk about is stop orders. A ratio writer can use buy or sell stops on his stock position in order to automatically and unemotionally adjust the ratio of his position. This type of defensive strategy is not an aggressive one and will provide some profits unless there are rapid changes in the underlying stock. A buy stop order allows the ratio writer to automatically convert the ratio right into a covered right if the stock moves up too far. Once the stop goes off, he has a position that will make some profit as long as the stock does not have a substantial price reversal. It is an unemotional strategy that will produce some profit. However, the writer may be tying up relatively large amounts of capital in order to only make a small profit. Now we're going to talk about the placement of stops. Ideally, stops are placed at prices that allow a reasonable rate of return to be made. It is also important to have the stops far enough away from the original striking price to reduce the changes of a whipsaw occurring. If a writer is willing to accept lower returns, he will be able to place his stops further from the original striking price. If the writer wants a higher return on their investment, the stops must be placed closer in. Now we're going to talk about closing out the write. The methods of follow-up action I just spoke about deal with the eventuality of preventing losses. However, if all goes well, the ratio write will begin to accrue profits as the stock remains relatively close to the original striking price. To retain profits accrued, it is necessary to move the protective action points closer together. This allows the writer to adjust the position while they still have a profit and lock in the profit. As a ratio write nears expiration, the writer should be concerned with the narrowing profit range and may need to take action. In summary, ratio writing is a viable, neutral strategy that can be used at all different levels. There are potential losses to either the upside or downside, and follow-up action is required. Vast quantities of time value premium are sold, and the strategy is profitable for the most probable price outcomes of the underlying stock. However, there is a large probability of making a limited profit if the position can be held until expiration without frequent adjustment.
This concludes our presentation. We hope you found it both informative and interesting. Thanks.